Hi, I'm Aoife Devitt, and welcome to today's Markets Happy Hour podcast. It is shortly after 1:30 on Friday, October 17th. We're coming to you about a half a day late due to some logistical issues yesterday, investment committees, etc. And of course, there's been plenty of news to cover in between. So let me bring up the slides and let's kick this straight off. Well, I've called this podcast Prizes and Prices, as clearly the Nobel Prizes, both peace and economics, have been in the news this week. And we've also heard quite a bit about prices. Whether that was 1 week ago, President Trump speaking about prices around China and tariffs and suggesting that the Chinese suggestion of them going to restrict the export of rare earth minerals would lead to him placing 150% tariffs on Chinese goods. That did create what we've described here as a white knuckle moment for markets. And there's also been discussion around drug prices this week as well. President Trump has announced that he is not only bringing the price of IVF and fertility drugs down, but there was a suggestion that also GLP-1 drugs would be brought down to a much more modest level. So that is a campaign promise that he will be delivering upon, and good news for the consumer. Too early to say at this point the effect that that would have on markets. So let's kick this off. As usual, we speak about inflation, interest rates, geopolitics, equity markets, and other. And in the other category today, we are going to have a little bit of a deep dive into the Nobel Prize of Economics and what they said about growth and what are some of the learnings that we could take from that prize about growth and what it means for where growth is likely to be most fertile around the world. So we'll also discuss a little bit about gold, up now 65% year to date, as well as Bitcoin, that is showing an interesting correlation with US-China relations. We have only anecdata and not any actual data this week, as we know that the US government shutdown has led to an inability to get inflation as well as employment data. So we will take what we can from the fragments that we're hearing from CEOs who are making utterances around corporate earnings. We know that bonds have been shining as the expectations of interest rates have come down. Is there unfettered optimism in markets, or are we seeing that these white knuckle moments are getting a little too frequent and perhaps signaling something a little more ominous in markets? We'll take a look at that. We're also going to dive, as I mentioned, into some of the mystery and culture of what creates growth in some regions and not in others. And it may perhaps help us to rethink some of the conditions that we're creating that may or may not be conducive to growth. Okay, so it's only anecdata that we have this week because we haven't seen any official inflation data or any official employment data. But what we can say is that the CEO of Walmart has suggested that his consumers, their customers, are showing some resilience. And this is, of course, the lower income customer at the lower end of the income spectrum. So this would be seen to be a somewhat consoling sign that we're not seeing too much of this inequality permeate through consumers, that they're not feeling the pinch too badly at this point. We remember from last week that the expectations around inflation are somewhat anchored, particularly at the 2% level. And that is, again, a sign that inflation expectations have very much come into check. What we do cite this week as been a potential cause for some of that low inflation is the fact that oil prices have dropped to their lowest level in nearly 5 years. Most of that is attributable to high inventories in the US. When President Trump said to drill, baby did drill. And now we can see that the inventories are topping 14 million barrels a day, which is quite substantial relative to recent history going right back 25 years. And I would say that notwithstanding the development of Middle East peace talks and a truce there, I don't think that that is affecting the oil price to the same extent of the actual demand and supply picture. We do have some data around the world when it comes to inflation. In particular, I'm looking here at the UK. They showed a second print for August of 3.8%. Quite troubling given there is a stickiness there and quite a bit higher than where we were a year ago at 2.2%. So a very nagging problem for the UK here. On the positive side, if we're doing a vibe check in this section, we can say that the economic picture in the UK has looked slightly better now that the Chancellor has been resolved around cutting public spending as well as raising taxes. Markets gave their vote of approval to that particular piece of news, and they reacted by buying up UK long-dated gilts. So we saw the most precipitous fall in that yield since April of this year. So a bit of positive sign from the UK, despite the fact that inflation is still proving quite sticky there. Looking here at bonds and what's going on for bonds. So we do know that rates are coming down around the world. We do expect that the next move for the Fed will be down. Bonds are now starting to reflect that by showing falling yields across the curve, not only at the 2-year end, but also at the 30-year end. So this will of course, erode what the investors can make on bonds in their portfolio. It'll make cash be a bit more of a drag, although as long as inflation remains subdued, there will still be a positive real return from cash. What we can also see is that according to fund managers, they're seeing a reasonably high amount of liquidity in bonds and that has been favorable for trading conditions. And all of this discussion around bonds, it's important to look at the dollar and what the interest rate movement means for the dollar. There's been a lot of discussion around currency debasement, whether the dollar is on a downwards trajectory. And what we can see here is that although the dollar has been weaker so far in 2025, it seems to be fairly valued relative to its long-term history, going right back to 1970 in this particular chart. So if it's fairly valued, this would be somewhat supportive of the dollar holding its value now through the end of the year. There has been also, with the geopolitical developments, a bit more positive confidence, perhaps in the US, and now that peace has been an indication that that could be something of interest. Moving now to equity markets, we've spoken about the white knuckle effect that last week's tariff announcement caused. It showed that even though markets have become somewhat accustomed now to tariff news and to the uncertainty around its transmission, not knowing when exactly tariff is going to have an effect on the economy and who's going to pay the price, markets were still not ready for a shock to the degree that President Trump presented in the Truth Social post. The idea of 150% tariffs on China clearly smacked of a trade war that would be beyond the bounds of what markets were factoring in currently. And they reacted with what's been described here as a white knuckle moment. And as we'll show later, there has been a spike in market volatility in response. If we look to how index performed, we can see that there was a whipsaw around markets after, over the course of the weekend, President Trump reined in some of his comments, and there seemed to be more of an entente cordiale between the US and China. What we can also see here, though, is that clearly rare earth minerals and the supply of them is a very sensitive topic. They're clearly critical to the AI wave. Bitcoin reacts quite severely to any uptick in US-China tensions and tariff news. And looking at this chart on the bottom left, it's interesting to see that while many countries share global reserves of global rare earth mining production, we can see that the production is dominated by China at the moment. It now represents 68% of global production, with the US just behind, quite a far behind it at 12%, Myanmar 11%, and then Australia 5%. And the other countries which have a reasonable share of reserves, such as Vietnam, Brazil, India, they do not yet have a reasonable share of production. So quite a bit to go there in terms of the reserves being reflected in production. China is still very dominant, and clearly that is a stick that it knows how to wield when the time is right. So we'll be watching that very carefully to see how that is a factor in trade relations. The market has not stopped with its white knuckle movements, though, and just today we are seeing much more concern around banks and a bit of a flashback to the spring of 2023 when regional banks there experienced a crisis. We can see that the fear gauge, as expressed by the VIX, is at its highest level since April. The concern focused on Zion Bank and Western Alliance, and a suggestion that these banks were exposed to bad debts and perhaps there had been sloppiness in due diligence in credit checks. This, of course, smacks very much of the type of concern around regional banks that was in place at the beginning of 23. At that time, it centered around the exposure to commercial real estate, and there was also concern around SVB and concentration of clients. I think it's important to step back and take a look at the US regional bank market. It is a somewhat fragmented market and is unusual on the global sphere, as globally, for example, in the UK or Europe, there is not the same chain of regional banks. There's much more concentration in a few large banks. And post-COVID, those banks have continued to consolidate, and some of them could in effect be too large to fail. And that would be the same for many of the US large bulge bracket banks. When it comes to regional banks, they are more exposed. Some are more exposed to certain sectors, certain types of lending, such as SME lending, or in the case of SVB, of certain types of clients that were perhaps used to a concierge service, but did act as one when there was a desire to redeem from that bank. So diversification by client type, by lending type is definitely key in the banking sector. Regional banks don't always display that kind of diversification. So concerns about the health of that have naturally trickled through into the entire financial sector. And that has been a drag on markets so far today. So we'll be continuing to watch that because of what it may potentially tell us about the state of credit markets and its health. Looking at some other factors across the equity markets, an indication that perhaps despite valuations being quite toppy previously, that price to sales is now getting quite high for the S&P, and we've got some more charts later to show exactly the same thing. Price to sales now getting ahead of 3 times, suggesting that it might not perhaps be the bargain that we would have said it was before. And looking at a segment that often gets overlooked, maybe doesn't have the most amplified voice, farmers. When it comes to soybeans, we've heard about the precipitous fall in demand for soybeans in the US because of China essentially switching its import of soybeans from the US to Brazil. This chart here just shows how sudden and severe the uptick in imports from Brazil was for China. And even though there is still a reasonable amount imported from the US, that amount could very likely fall over time. And soybean prices have responded in kind. The bottom left shows the price of US soybean futures lagging the Bloomberg Spot Agricultural Commodities Index badly. So a double whammy for farmers, no demand, and therefore prices following suit. So this is something, of course, to watch because it will no doubt have to be accompanied by some subsidies, some compensation to farmers who are enduring this. And it also creates a specter of a reorganization of the world trade landscape according to the new set of rules. And this, of course, is something that we will have to keep watching carefully. Moving from white knuckles to cockroach moments, and we have Jamie Dimon to thank for moving us beyond the canary in the coal mine metaphor into now thinking about cockroaches, less palatable to some perhaps. His cockroach metaphor was referring to the specter of 1 or 2 bad incidents, such as in the case of First Brands and Tricolor that we mentioned last week, being just like a cockroach, and that when you see one, there's rarely only one, there are often more where they came from, suggesting that even though in his case JP Morgan was actually implicated in being one of the lenders to First Brand, that there is probably a sign of greater malaise in the sector, other due diligence shortcomings, other promises that cannot be kept. That has not yet been reflected in default rates. As the chart on the left shows, both leverage loans and high yield bonds have seen considerable downturn in default rates, nowhere close to their peak. This is the norm. There are still bad apples among that. And getting back to the root cause of why this fraud was not seen and why it was essential, there was so much broad-based exposure in the CLO market as well as the private credit market more broadly. A suggestion here in the Financial Times from an executive at a former lender to First Brands had said, "You're not paid to do due diligence in this market." That is quite a chilling admission. If there is simply not enough margin to pay for basic due diligence, which could have averted at least many of these banks being exposed to that. This begs the question as to whether the crowding in the market has driven down returns to a point that there is not enough excess available to conduct basic due diligence checks. That is surprising somewhat and makes me wonder at what price one does consider they are paid to do due diligence. So again, as interest rates come down, and the private credit segment is a segment that will have a much more sensitivity to rates because it's floating rate. Their returns will come down as the interest rates come down. We need to see whether there is enough left for due diligence. And when we conduct our own due diligence on private credit firms, this is definitely a question that we need to be asking. So far, despite the fact that it has not been more broadly felt, there has been a negative return in the US leverage loan market for the last month. The last negative return was at the beginning of the year. So clearly some fallout from some of this concern. Some thought experiments here a little bit to take us to the end of the podcast. It's an interesting, I think, to do some lateral thinking around AI. All of our discussion last week was around an AI bubble. And as we'll see later, that is still the greatest tail risk on the mind of fund managers today. However, it's important to also go back to the data. And as this chart shows, when we look at US GDP data, so far AI related components are not actually representing that much. That is quite interesting. We think a lot about AI spending, the massive amount of capex that will be spent in the future, the big build outs we're seeing around data centers. The interesting part is in terms of productivity and actual feeding into US GDP, we're not there yet. That could be a very positive sign in case we think that all this will feature down the line. But it also is, I'd say, even more positive in the sense that the economy and the stock market, although they're connected, are not the same. So when we see the strong GDP growth in the economy and we see the strong stock market, we automatically link them. The reassuring thing here is that both are independently strong at this time, and that should give us some comfort that the US GDP at this stage is not being powered by AI. Equally, we have blamed some unemployment figures and employment weakness on AI replacement. And this chart here shows that so far it hasn't really been being a factor, that the biggest increase in unemployment have been in the two segments with the highest and the lowest exposure to AI. I think this is very interesting, as clearly the highest exposure to AI would be expected to be replaced first. So we can see that ticking down. But if we look at the segment with the lowest exposure to AI, if that is also seeing an uptick in unemployment, that might be more concerning, suggesting that there is something just structurally wrong in the employment market, that AI has nothing to do with the replacement. This may perhaps be lower skilled workers, but there's definitely no room for complacency when it comes to the employment market at the moment. Some more rethinking and looking at wage growth. We've spoken in the past about rising inequality and how it's been the case that the top earners have continued to earn more and the bottom earners have been more affected by regressive taxes and essentially more affected by inflation and inability to get on the ladder. This chart on the left suggests that weekly wages, the bottom fifth share of aggregate weekly wages has risen and the top fifth has fallen. So these are very marginal changes, it should be said, 1%, 2% at most, actually 1% in this case. But it is interesting to think that there is a little bit of a move in the price of labor at the lower end. This would, of course, have been lagging, would probably have come from inflation more generally. But it is interesting to see that there's a little bit of a move around in terms of the share that the lower end wage earner is taking out of the aggregate wage bill, but nothing seismic at this stage. Another reflection here on just equity market valuation, we can see the forward 12-month PEs on the S&P are now between 20 and 25x. So definitely higher than, as high as they get, essentially. So we're not in an undervalued territory, and the return on common equity on the S&P has been high. So we are at a point where these record highs we're seeing in equity markets are translating definitely into valuations. I thought I'd spend a minute on the Nobel Prize. We've been focused on the Peace Prize, but the prize in economics was particularly interesting this year, I believe, because it speaks about growth, about what the factors are to generate growth in markets. And it has been a conundrum for many thinkers, commentators, economists, as to why the US has broken away by so much when it comes to growth relative to Europe at this particular juncture. We know that the US had less regulation, more innovation, more of an entrepreneurial climate, and certainly up to now, more of an open approach to immigration and to growth, and definitely has outsourced some other labor around the world as part of globalization. So it'll be interesting to see if these trends now start to change and reverse, and what kind of a climate that creates for growth going forward. The three economists who won the prize, there is a summary of some of their thinking in the Financial Times. And some of the pointers, which I thought are just worth remembering, is that growth is often resisted. And they cite the example of during the Industrial Revolution, when in the UK, there was resistance to going into factories. The agricultural workers did not like to have structured days to work for anybody other than themselves. And there was initially a need to get workers into the factories such that the factory owners had to recruit women and children to do the work. And it was only later that men became factory workers. So definitely resistance, the need for time for growth to actually take place. Clearly over the course, say, of the Industrial Revolution, we were talking about decades. That time perhaps is being compressed today, but it is important to think about having the time that growth normally takes. And in that case, having being able to be patient about growth, not perhaps emerging throughout the world to the same pace that we would expect. It says it's cultural, and we've already touched on this, the culture of innovation, a culture of less regulation, less big government. This can be conducive to growth at times, and similarly, an openness to growth. It is unpredictable, so we cannot necessarily forecast the future. There's been a huge demand to try to forecast the future around AI, and it has been very difficult to do, and that's normal. And this is perhaps something we need to remember when it comes to growth. And finally, it's not inevitable. So we shouldn't expect it to be necessarily flowing from the fact that growth has occurred before. We have to be asking whether the cauldron of influences and of circumstances is in place such that growth could occur. And I think it is an important salutary warning here that the prize is a warning about the future of progress. This chart showing that growth is not inevitable showed that the period of growth in 18th and 19th century Great Britain coincided with periods of greater openness, and a suggestion that the cauldron of new ideas and technologies was more important than simply build, build, build. And then there is the graph showing that 11 trillion gap in nominal terms between the GDP growth in Europe and the US, having started out at more or less the same point in about 2008 or 9. Just how much that has diverged since then, quite extraordinary. A few other bits and pieces of other news. We saw Polymarket, the betting market that came to the fore when it predicted accurately the results of the presidential election last time round. It has been useful in predicting other outcomes around the world. We can see that has now been acquired by the New York Stock Exchange. So let's see what that means about the future of political betting as well as other betting, and how that intersects with other, say, ways of investing or expressing ideas through investment. We have talked about gold now being up 65% since the beginning of the year. And this chart on the left plots gold alongside Bitcoin. And the interesting part there is that Bitcoin has been very choppy, whereas gold has been much more steady in terms of its rise. And part of the reason for the choppiness in Bitcoin is it seems to be the dependence that Bitcoin has on news coming out of China and US-China trade developments, whether that's something to do with rare earth dependencies or other suggestion of tariffs and shipping affecting it. It's unclear, but clearly quite a bit of volatility still creeping in to Bitcoin. And finally, just to refer back to that really useful fund manager survey that comes out every month, where are fund managers seeing the biggest tail risk in markets today? I mentioned earlier AI bubble. We talked about that last week. That is now at the top of the list in terms of tail risk, 33%. But the second wave of inflation remains to be important. It is not as important, and that's been about steady at that level for the last 3 months. Dollar debasement and Fed independence worries are abating, possibly because as we near the date of Jerome Powell's retirement, we probably have less concern about the independence being lost. And bond yields, geopolitical conflict, trade war triggering recession, all receding as tail risks in the eyes of fund managers. And that's interesting to see, just that it's really all eyes on AI at the moment. So that is it for this week. Thank you for listening. We'll be back next week with a special guest from IFM Investors, and look forward to seeing you all then. Have a great weekend.